Hello, it's ChewDog Charts. Now, before I started recording this video, I wasn't sure what I was going to talk about. There's so much information out there, so many things impacting the stock market and the economy that it's hard to choose from day to day. But I think subsequently we'll get to all of the information in due time. So what I'm going to talk about today is some astonishing, some unbelievable, and some predictable information. But first, I wanted to explain the title of today's video. It's called Three Dog Night. And I've called Three Dog Night for a couple of reasons. First of all, Three Dog Night was an old rock group. And we can go into how they got their name later. But they wrote a song called One is the Loneliest Number. And basically some of the lyrics go, one is the loneliest number that you'll ever do. Two can be bad as one. It's the loneliest number since the number one. And I've titled this is because I used to have only one subscriber. And he must have been the loneliest subscriber for the longest time. But now we've got two. So two can still be as bad as one, but at least it's two. And actually there may be three of us. I haven't subscribed. I could always do that. I won't. But there's three of us. So just feel comfortable in the knowledge that the three of us, we're going to go through this information, and I promise you, you're going to have the edge in your trading. Earlier, I had wanted to do a video update on the margin debt. Basically, the information comes out at about the end of the month, and it's already a month old by the time it comes out. So it's usually best to get to that information as soon as possible. But it's going to have to hold off. Because today the market is screaming. The Dow is up over 24,000, probably in anticipation of the tax cut plan passing. And so that's why the title of this video also comes in, is when the market is screaming, and I as a contrarian, or you, may not be able to fully participate in a stock market rally, it's difficult to be on the sidelines. However, I'm actually glad I'm on the sidelines. I'm missing out on some money, but in the long run, I know that I'm going to be able to take advantage of the carnage that I believe is coming soon or soon enough. When the stock market either has a correction, a bear market, or potentially a crash, I'm going to be prepared. And I hope you will be prepared as well. So let's go take a look. Exhibit number 1 is the Dow reaching over 24,000 in anticipation of the tax cut plan being passed. Recently, Zero Hedge put together a list of expectations from some major banks. The expectation is for the year-end 2018 and includes the S&P target, the earnings per share on the S&P, and the PE ratio. On the list, Bank of Montreal with an expectation of $29.50 on the S&P, earnings of $145, and a PE of 20.3. UBS has an estimate of $2,900, the earnings per share of 141, and the PE of 20.6. Canaccord has an estimate of $2,800, earnings per share of $140, and a PE of 20.0. Credit Suisse has an expectation of $28.75 on the S&P with earnings per share of 139 and a PE of 20.7. Deutsche Bank has an estimate of $28.50, earnings per share of 140, a PE of 20.4. Goldman Sachs, and pay attention to this one, Goldman Sachs has an estimate of $28.50 on the S&P, earnings per share of 150, and a PE of 19. Citigroup has an estimate of $26.75 on the S&P, earnings of $141, and a PE of 19. HSBC has an estimate of $26.50 on the S&P with earnings of $142 and a PE of 18.7. Not on the list is JP Morgan. However, recently, JP Morgan's chief economist published a special report titled U.S. Outlook 2018, Eat, Drink, and Be Merry for in 2019... But here are the 7 reasons that JPM believes that the party will continue until at least December 31st, 2018. Number 1 on the list is that growth momentum at the end of 2017 is solid and global headwinds are unusually mild. Number 2, solid growth should put more pressure on resource utilization for an economy operating at capacity. Number 3, wage growth has already firmed and unemployment rate is expected to fall below 4%. Number 4, core inflation should approach 2% target rate following surprising weakness in early 2017. Number 5, even with tightening labor markets, subdued inflation expectations should limit upside price pressures. Number 6, the Fed is on track to deliver 3 hikes this year, and we believe will step up the pace to 4 hikes in 2018. And number 7, the year-end period usually contains one wild card. This year, it's tax reform. But as we can see, today's red-hot market again is in anticipation of the tax cut plan passing. So we come to exhibit number 2. 1 week after the Goldman chief equity strategist predicted a 3-year bull market of rational exuberance, they lifted the 2018 S&P price target from 2,500 to 2,850 as indicated earlier. But they also predicted a rise of the S&P to 3,100 as of 2020 and stated that if there is exuberance that turns irrational, the S&P could rise as high as 5,300 by 2020. However, in a report that was released on Tuesday titled The Balanced Bear Part 1, Lower Returns and Latent Downturn Risks, Goldman turns 180 degrees and warns that in the medium term, 2 likely scenarios are either a slow pain, which would be a deflation scenario of low yields and high valuations, which persist as macro is stable, but there are less windfall gains from rising valuations and less carry. As a result, returns are likely to be lower across assets. Or a fast pain, the drawdown scenario in which there is either a material negative growth or inflation/rate shock, or a combination of both, which drives a drawdown in 60-40 portfolios. Now, a 60-40 portfolio is simply 60% weighting in the S&P 500 with 40% weighting in U.S. 10-year Treasury bonds. So while on one hand Goldman is predicting nothing but blue sky for the medium term and the next 3 years predicting no recession and double-digit equity upside at the very same time, another Goldmanite is forecasting either slow or fast pain. So looking at the chart here, we are nearing the longest bull market for balanced equity bond portfolios in over a century. Again, using the simple 60-40 portfolio, 60% S&P and 40% U.S. Treasury bonds, has not had a drawdown of more than 10% through 8.7 years and has delivered a 143% return. So, as we take a look at this chart, go back and find out when the next most similar period of time was. Well, it was right before 1929, when the market went on for 9.1 years with a rise of 376%. Now, if you look at the chart in more detail, To the best of your ability, if you can see, you can go back and take a look at these other periods of times and see how they line up with interesting points in time. If you can see my cursor right here, this sort of aligns with 2007 and 2008. This point here aligns with the year 2000. Now, I'm not sure about all of these other points in time, but just by simple observation, this time frame and these rate rises coincide fairly well with some pretty bad periods of time in our stock market. And then the last exhibit, more doublespeak. Goldman Sachs came out with a report yesterday indicating that a prolonged bull market across stocks, bonds, and credit has left a measure of average valuation at the highest since 1900, a condition that at some point is going to translate into pain. A quote from the report reads that elevated valuations increase the risk of drawdowns for the simple reason that there is less buffer to absorb shocks. The strategist who wrote the report continued, the average valuation percentile across equity, bonds, and credit in the U.S. is 90%, an all-time high. And another quote, it has seldom been the case that equities, bonds, and credit have been similarly expensive at the same time, only in the roaring 20s and the golden 50s. A Goldman Sachs international strategist wrote in a note that all good things must come to an end, and there will be a bear market eventually. Well, that's some astonishing, unbelievable, and sadly predictable information. So I'll be on the watch, and hopefully you all continue to be on the watch out for anything coming up on the horizon. I would appreciate more subscribers and viewers. But for now, that's ChewDog Charts. Thank you.